Our topic for this episode is entry system and accounting equation, which are part 2 of basic bookkeeping course. The first step to recording the company's financial transactions is creating a chart of accounts. This is a list of accounts that will be used to record and classify financial transactions. Each account created will be classified as either asset, liability, capital or owner's equity, revenue or expense. The classifications of accounts in accounting are as follows. 1. Assets. Assets are the properties, possessions or economic resources of a business that help in business operations and in earning revenues. Assets are also anything that is brought into the business to be used directly or indirectly in earning revenues or income. Assets are measurable in terms of money. However, assets of a firm may be tangible or intangible. For example, land, building, furniture and fixtures, plant and machinery, vehicles, receivable from debtors, accounts receivable, bank balance, cash, etc. 2. Liabilities. Liabilities are the amounts that an entity owes to the outsiders, or the obligations or the debts payable by the entity. We can also classify the liabilities as long-term and current. Examples of liabilities are bank loans, creditors, bills, accounts payable, rent outstanding, short-term loans, bank overdrafts, etc. 3. Capital. Capital and owner's equity is the money or the cash equivalent of assets that the owner brings into the business. We use the term capital account for single proprietorship or partnership, while we use the owner's equity account if it is a corporation. The owner can bring capital in the form of cash or assets like office equipment and merchandise for sale if the business type is retail. 4. Revenues accounts. Revenues are the income generated from normal business operations. Revenues are also referred to as sales, as they are used interchangeably in practice. The following are examples of revenues. For retail store, it is the selling price of sold merchandise. For real estate, it is the selling price of sold house and lot. For the practice of profession, for example the lawyers, it is their professional fees. 5. Expenses accounts are the money spent, are costs incurred by a business to generate revenues or income. The following are examples of expenses. Cost of merchandise sold, also referred to as cost of goods sold, store space rental, electricity, salaries of employees, transportation. Now, let's move on to the accounting equation. The accounting equation shows on a company's balance sheet that a company's total assets are equal to the sum of the company's liabilities and shareholders' equity. Hence, the formula of accounting equation is assets equals liabilities plus capital or owner's equity. Or, capital equals assets minus liabilities. Accounting equation is also called the balance sheet equation. This means that each debit has equal credit and vice versa. To better understand this, let's move on to the entry system of bookkeeping, which are 1. Single entry. 2. Double entry. Single entry bookkeeping is where a transaction only has to be recorded against one category, either an income account or an expense account. This is a cash book, which is a perfect example of single entry method of bookkeeping. You will note, in this example, that recording is done singly or just once per transaction. This method is usually adopted or used for small or startups, usually single proprietorship. On the other hand, the double entry system of bookkeeping means that for every business transaction, amounts must be recorded in a minimum of 2 accounts. The double entry system also requires that for all transactions, the amounts entered as debits must be equal to the amounts entered as credits. To illustrate double entry, let's assume Sarah put up the Sarah's Mini Mart, a grocery, as her business. For a start, on September 1, 2020, Sarah withdrew from her personal bank account $5,000 as her capital. As Sarah's bookkeeper and applying the double entry system or method, you will have to take up the following entries: debit cash and asset account for $5,000 and credit capital for the same amount of $5,000. Then on September 8, 2020, Sarah bought in cash, merchandise for sale worth $3,000. The entry is debit asset account merchandise inventory and credit cash another asset account for the same amount of $3,000. Then on September 15, 2020, Sarah bought, on credit, a laptop, for the business use, worth $1,000. Your entry would be debit office equipment and asset account and credit accounts payable a liability account for the same amount of $1,000. Take note that if we summarize your entries for the 3 transactions it will look like this. The total of debit is $6,000, which is the sum of and is equal to the total credit, which is also $6,000, the sum of $1,000 liabilities and $5,000 capital. Again, take note that based on the same assumptions and entries, the balance sheet of Sarah's Mini Mart as of September 15, 2020 would look like this. Cash is $2,000, merchandise inventory $3,000, office equipment $1,000, so the total asset debit is $6,000. Credit accounts are accounts payable $1,000. Capital $5,000. Add the 2 credit accounts and we will arrive at total credit of $6,000. In our example, please note that the accounting equation remained in balance because total assets is $6,000 and total liabilities plus capital is $6,000, hence we can say that we have successfully applied the dual aspect concept or double entry system and also fully complied with the accounting equation in our given examples.